In this lesson, I'll cover market patterns. Now, in trading, market patterns are really important as they signal reversal or continuation zones in the market. Market patterns are patterns on chart formed by the flow of the market. And market patterns are the core in trading because they truly indicate potential reversal or continuation zones. Usually market patterns have tops, bottoms, shoulders, heads, and other formations. Identifying market patterns is something that you should always look for as a trader when you trade the Forex market. Some of the most common patterns in the market are double top, double bottom, head and shoulders, inverse head and shoulders, ascending channel, descending channel, symmetrical triangle, rising wedge, and the falling wedge. And I'll discuss all of these in a bit. Besides these market patterns, there are a couple other patterns you should also know, like the triple top and the triple bottom. And those really aren't that common in trading compared with the market patterns I've just mentioned. Now, I explained the importance of market patterns in trading, so let me show you some examples of market patterns. The category of market patterns contains lessons which include the market patterns I mentioned, but for now let me show you other examples of market patterns so you can understand and recognize them. A double top pattern is formed when the tops, also known as resistance zones, a double top pattern forms a neckline, which acts as a support zone. The break of a neckline indicates the potential bearish trend in the market. Double bottom is a reverse double top pattern. The double bottom pattern doesn't have the tops, but has the bottoms, which act as support zones. Besides these bottoms, a double bottom pattern also forms the neckline, the break of which can lead to a potential bullish trend in the market. The head and shoulders pattern is formed by the left shoulder, the right shoulder, and the head, which forms above the shoulders, and the tops can act as resistance zones. The neckline also forms on a head and shoulders pattern and the bottom, and the break of the neckline can result in a bearish trend in the market. On the other hand, inverse head and shoulder is a reverse pattern of head and shoulders. The left shoulder, the right shoulder, and the head don't form at the top, but at the bottom. The bottoms act as support zones. Inverse head and shoulder patterns also have the neckline at the top, which acts as a resistance zone. An ascending channel is a bullish channel that's used to identify an uptrend in the market. And an ascending pattern forms when two parallel lines and a break of the parallel lines that indicate the end of a bullish trend. A descending channel is a bearish channel pattern, which identifies downtrends in the market, and the break of a descending channel can indicate the start of an uptrend in the market. Symmetrical triangle patterns contain at least two lower highs and two higher lows. As you can see on the screen, the symmetrical triangle pattern can indicate the continuation or the reversal of a trend. The rising wedge pattern, also known as the ascending wedge, is formed when the price abounds between the two rising trend lines. A rising wedge pattern uses two connected parallel lines. The break of those lines can indicate a downtrend, and if the price continues to go up, then it's a really powerful indicator of an uptrend. The falling wedge pattern, also known as the descending wedge, begins wide at the top and then contracts as prices move lower within the two parallel lines. A falling wedge can indicate a continuation of the downtrend or the reverse of the trend. Now, a triple top pattern is similar to a double top pattern in that it's formed by three tops that act as resistance zones and a neckline that acts as a support zone. The break of the support can indicate a downtrend in the market. Meanwhile, a triple bottom pattern is similar to a double bottom pattern, and it's formed by three bottoms that act as support zones. Now, besides the bottoms, a triple bottom pattern also has a neckline. The break of the neckline indicates the break of the resistance zone and a potential uptrend in the market. So these are the market patterns you as a trader should know because they're really, really important to the movement of the market. This lesson is just a short interlocution of these market patterns. The category of market patterns contains separate lessons about the market patterns I mentioned, and I'll show these using real-time charts. Now, let's move to the lesson on Fibonacci.